Unit 2, the financial environment. So the financial environment is an important um, environment within which the organization must operate. There are types of markets within which an organization must operate. We need to understand these. And so, what is a market? Basically, a market is a venue where goods and services are exchanged. So we have a financial market, a place where individuals and organizations want to borrow funds. Those that have excess will lend funds in that market. So financial markets in an economy are interaction between corporations and financial intermediaries. They are lenders and borrowers. And this occurs for purposes of facilitating the raising of capital, the borrowing of funds, and ultimately spiking economic growth. So financial markets will facilitate the transfer of funds from those that have excess to those that are without. So these are found in the financial system where there are players who we call lenders, borrowers, investors, and intermediaries. Intermediaries include financial institutions. So the financial intermediaries may include commercial banks, the stock exchanges, the investment companies, insurance companies, pension funds. These may come in the form of borrowers and lenders, in the form of individuals and firms. So funds will move directly and indirectly in the financial markets as follows. So we have the lenders. The lenders can directly take the funds in the financial markets where trade takes place, or indirectly through financial intermediaries who take money into these financial markets. Financial intermediaries sometimes will act as markets in themselves where they will lend these monies to borrowers, who may include government, firms, individuals, and foreigners. So this is the flow of funds in the financial system. So the functions of the financial markets is that they will channel funds from the savers to government or other individuals, directly or indirectly. Now, how is capital transferred between these two parties? So in indirect finance, borrowers will sell um, their funds using intermediaries. In direct finance, borrowers will sell these securities directly to the lenders by issuing bonds or buying these shares. Now, why is this channeling function very important? Because markets are there to create value. Savers will get interest and will spend it later. So people who give money will use opportunity cost or time value. Why am I giving out money now for later? Because of the aspect of interest. And so there are different types of financial markets. We have what we call the debt and equity markets, the primary and secondary market, the exchanges and over-the-counter markets, and the what we call the money and capital market. So now what is involved in each of these markets and how um, the players and who are the players in these markets? So we're dealing with the debt and the money market. We must understand that the debt markets are to deal with bonds. They deal with borrowing instruments where the issuer will promise to repay the principal with interest. So we have government bonds, corporate bonds, and the equity market actually deals with what? Ownership of instruments like shares of stock and giving investors partial ownership of the company, like I mentioned. We also have primary and secondary markets. The primary markets are simply markets where you issue securities for the first time. We call that IPO. Companies will raise funds directly from the investors. And secondary market, this is where existing securities are traded among the investors. So the issuing company does not receive funds directly from these. Examples will include the stock exchanges. So we also have exchanges and over-the-counter markets. Exchanges are simply organized or formal platforms where securities are bought or sold under strict regulations. We have the Lusaka Stock Exchange. Over-the-counter markets are decentralized networks where these securities are traded directly between parties, often using less standardized instruments. Then we have the money market and capital markets. What is a money market? It is simply a market where short-term debt instruments are issued, like maturities are less than a year. Treasury bills and commercial papers are good examples. And capital markets, they deal with long-term securities like bonds, stocks, where funds are raised for long-term perspectives. So these markets should be known at your fingertips. Now, I've talked about the debt market, which I'll talk about specifically as I'll be taking you through bond valuation and stock valuation. So a debt can be short-term, long-term, and intermediate. Primary markets, I've talked about it, where we're looking at stocks that are issued for the first time. And over the counter markets, where buyers and sellers will meet on one central location. Okay. And now we must understand the importance of allocation of these funds. These funds will allow for flow of economic units from those that are willing to give excess, holding at interest, and to those that are expecting to use money for expansion purposes now. So the savings are what I use as investments. So what are some of the factors that affect the security of these expected returns? There is what we call default risk. There's what we call marketability. There's what we call maturity. There's what we call taxability. So these are some of the what? The factors that will affect what? The returns that are involved. There's an assumption to say the higher the risk, the higher the returns. So there are factors that will affect how attractive these securities are. So when talking about um, the expected return of a security, we're looking at the profit that you're expecting. So factors like default risk, the risk that the issuer may fail to pay at the promised interest and payment. So the higher risk usually will lend to higher expected returns. Then marketability, how easily the security can be bought or sold in the market without affecting the price. Maturity, we're looking at the time until which the security will be repaid. This is another factor that affects the returns of the security. And the inflation is anticipated what? Um, Reduction in the real value of these future cash flows. So investors will require higher nominal returns that will offset this erosion of the purchasing power, which is caused by the same inflation. So basically, factors that affect security, talked about these, maturity, etc. So this is basically the market environment within which these corporations will trade. So this is all about the um, environment. Unless there are any questions, I can just ask quickly, quick questions from what I've discussed. What are some of the factors that affect the expected returns for a security?
Default risk, marketability, taxability.
Okay, good. Then the next question is we've talked about different types of markets that we have. Okay, in the financial markets, can we talk about any three markets we talked about? Any four markets?
In detail or
No,
just to
just
list them?
briefly. Yeah, just state them. Yeah.
We've got the primary and secondary market,
Mm-hmm.
uh, debt and equity market.
Okay.
Uh, yeah, that's what I have on my end.
Yes. What's the difference between the debt and equity markets? You can give examples. Okay. Um, I would say the financial environment is referred to what? A system of institutions, markets, and instruments and regulations that help to facilitate funds moving from what? The savers to the investors. So the importance that it ensures that there's efficient allocation of what? Of resources. So my subsequent question to that was you talked about there being a debt market and equity market. What is the difference? The debt market is simply a market where investors lend money to government or firms in return for interest like bonds and treasury bills. And equity market is where investors buy ownership in a company and earn dividends or capital gains. Examples are shares, the stock exchange. So question number two is what is the distinction between money markets and capital markets? You can give two examples. What's the distinction between money markets and capital market?
So a money market is a place where short-term instruments are traded, such as treasury bills or commercial paper, while as the stock market, this is where long-term instruments are traded. These would be things like bonds and stocks.
Exactly. Yeah. So more than a year, that's the capital market, looking at corporate bonds and equity shares. Oh, great. Um, Maybe lastly, um, I can ask, why is regulation in the financial market important? Why is regulation important in the financial market? And you can give examples. It's important because it protects you and me as investors from fraud and mismanagement. It also ensures that there's fair trading, it's transparency. You're able to know there's no insider trading, you know. It maintains financial stability. Examples of Bank of Zambia and the Securities and Exchange Commission. All right. Is that clear? Are we together?
That's clear.
All right. So we are done with unit 2. All right. Let me go to unit 3, which is time value of money. Unit 3. So here we're going to have a bit of some calculations. I only have 2 minutes to go. Uh, Sources. Oh, we'll go to sources of finance before that. Okay, so we can start.